Well, I mean, we are witnessing that inflation still falls short of our inflation aim of being close to 2%. So there has been an extended period of time in which inflation has been below our aim. However, if you ask our citizens, they think that inflation is 9%, which was actually the outcome of a poll that was held
9%,
today.
that's almost double digit.
Yeah, it must be housing, but of course, housing cost is not, at least owner-occupied housing cost is not included in the way we measure inflation. So there is a little bit of a gap here, and I think the strategic review will be an opportunity to close that gap.
Having just spoken to Mario Centeno and now hearing from you, I can see this fight, this tension on the ECB board, where you want this reassessment to take place, and others from other member countries don't necessarily think a change is the optimal as an outcome. Just talk us through why you think housing costs would make a difference to that inflation rate.
Well, first of all, I wouldn't say that there is a big tension in the ECB Governing Council on this strategic review. We all agree that inflation has been below our aim for a long period of time, and that we want to know better why this has been the case, why controllability of inflation has fallen short of our expectations. Why there is so much fundamental uncertainty, and also, of course, a question like, do we measure inflation correctly? In and of itself, that's a technocratic question. That's not a question of east versus west, north versus south. I think we just want to get at the right answer. And perception of our citizens is important. We have, I think, over the last few years, perfectionized our communication with the markets, but I think we've underestimated a little bit the importance of the 330 million citizens that we serve. And the review is an opportunity to sort of reconnect with our citizens also on this.
You have some breathing room while this review takes place if you see any change to monetary policy. But if the next move on that deposit rate was to move even further south on negative rates, how would you feel about that?
Well, I don't think that there is any need to speculate on any next move. At the moment, the situation is stabilizing.
Speculate on a move, but what if we saw a move south? Does that mean that we can just keep on going further negative, or we're as low as it can go on negative rates?
Well, I think that technically speaking, we haven't hit sort of the effective lower bound, so there is possibilities to go further negative. But we also know that there is decreasing returns to scale. We also know that there are important side effects that you have to take into account. So when push comes to shove, we have to make that trade-off and decide whether or not it is desirable. Technically, it can be done. We haven't hit the reversal rate yet. Whether it's desirable, that's a question that I cannot answer now, since I don't know what the conditions will be under which I have to make this assessment.
Speaking of those conditions and the wild cards, we've heard plenty of positive and negatives around a trade fight between the US and Europe. As negotiations play out, everyone's hopeful of some sort of quick resolution. But if that's not the case, President Trump has proved to be a tariff man in the past. Where would that leave central bankers and the sort of response required if a trade fight plays out between the two blocs?
Well, trade is a multi-pronged animal, I would say. Trade uncertainty is bad. It's invariably bad for demand, because it makes people uncertain and then firms stop investing. This is to some extent what we see now. So that is also bad for our sort of aim to achieve our inflation aim. But if trade uncertainty translates into concrete trade restrictions, they might actually have an upward effect on prices. It would be the bad kind of inflation, but it might actually have as a side effect that it will take us closer. Trade restrictions are a negative supply shock, and negative supply shocks lead to higher prices.
That's fascinating. We haven't got much time left. I want to get to the greening of central bank policy, because the ECB, the BOE, central banks on this side of the world focused on the impact of climate change for financial stability. United States, the Fed sees no imminent threat, but why do you think it's necessary to look at the risk for banks, for insurers here in Europe from climate change?
Well, it's pretty clear that if sort of the economy needs to undergo an energy transition, then let's say the sector that finances the economy, the financial sector, will also have to change its exposures, its risk profile, etc. And then I think it's of utmost importance that we, from the regulatory side, identify this shift in risk sufficiently early, and that we make sure that they correctly price these climate-related risks. And once they start pricing them correctly, then I think that will also facilitate the shift in funds from brown to green, which will make the energy transition a lot easier.
Does that mean banks need to hold even more capital again?
That's not necessarily the case. They need to hold capital against different types of risk, because their risk profile is shifting, and we want them to acknowledge that as soon as possible.
Hi, I'm Joanna Bersecci and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.